Suppose you invest 1 lakh rupees in Nifty 50 index fund. Of this, 40,000 will be invested in just 5 stocks. For example, about 12,500 will be invested in HDFC Bank, 8,000 in Reliance Industries and 4,000 in ITC. Now that's because each stock in the index has different weights. So the major portion of your investment is skewed in few stocks. We will discuss this in more detail later. For now, let's talk about the 3 stocks that we just mentioned. If you look at their past 1 year returns, they are not impressive. The 1 year returns of HDFC Bank, for example, are below 10%. Reliance Industries, on the other hand, has 0 returns. ITC has grown less than 5%. The point here is that a few heavyweights in the Nifty 50 index determine your overall returns from the index. For those who prefer passive investments but don't like a few stocks impacting the overall returns, there are equal weight indices. Hello and welcome to ET Money's YouTube channel. Today, we are going to talk about an interesting factor, equal weight. Now, as the name suggests, this factor allocates equal weights to all the stocks within an index. But by doing so, does it make the index better? In this video, we will discuss 5 features of equal weight factor that make it stand out. The performance of equal weight factors vis-a-vis their parent indices. Now, based on this, you can decide whether an equal weight factor fund deserves a place in your portfolio. So, if you're a fan of factor investing, this video will surely be helpful to you. But to get the most of this video, you must watch it till the end. Alright, let's start by talking about the 5 key features of the equal weight factor. The first feature that makes an equal weight index stand out is that it's much less concentrated both at the stock and sector level as compared to the normal index. Let's understand this in detail. Now, normally the stock weights in index are based on the free float market cap, which is based on the shares freely available for trading. So it excludes promoter shareholding, shareholding of trust, government shareholding, etc., which is deemed to be more stable in nature, and hence the shares are not available for normal trading. Generally, large companies have a larger free float, so they become dominant in free float market cap based index. For instance, consider the top names in Nifty 50 index and their weights. The top 5 stocks in Nifty 50 are HDFC Bank, ICICI Bank, Reliance Industries, Infosys and ITC. Together, their weight in the index is a massive 39%. Now, these 5 companies have such a massive weight as the index is based on free float market cap methodology. Quite obviously, these 5 stocks also have considerable sway over the index performance. However, this changes when the index components are given roughly equal weights. Now consider the top components of the Nifty 50 equal weight index and their weights. In the Nifty 50 equal weight index, the top 5 stocks constitute just 12% of the total allocation. Ideally, this number should be around 10% or so, and there should be no top stock as each stock has an equal weight. But this deviation occurs as the index is rebalanced every 6 months. So, in the interim, individual stocks tend to get higher or lower weights than the target equal weight. Nevertheless, concentration is considerably reduced in an equal weight index. Now, this swaying difference is also reflected in the sectoral composition of the 2 indices. The top 5 sectors in Nifty 50 are financial services, IT and oil and gas. Together, they account for almost 59% of the index's weight. In the Nifty 50 equal weight index, the 3 top sectors constitute just 45% and the third sector, auto, is different too from the parent index. So, the concentration both at the stock and sectoral level is considerably reduced. Now, this suggests that a handful of stocks can't significantly move an equal weight index, unlike the free float market cap based index, and a single sector has comparatively less control over the index's movement too. Inversely, the tail end stocks in a market cap weighted index get more room to register their presence and worth in an equal weight index. The second feature of an equal weight index is that its performance depends on the broad-based market performance. Now, because an equal weight index is less concentrated at the stock and sectoral level, it tends to do well when the broader market does well. If the rise in the market is led by just a handful of stocks or a couple of sectors, an equal weight index will likely fall behind a market cap based index. For instance, in 2018 and 2019, the market rally was driven by just a couple of sectors, IT, financials and services sector. So the Nifty 50 equal weight index didn't do as well as its parent. However, in 2021, 2022 and 2023, the market rally was more broad-based, which helped the Nifty 50 equal weight do better than its parent. Now the next feature of an equal weight index is that its valuation differs from that of its parent index. Equal weight indices can have different valuation multiples than their parent indices. Depending on the difference, this can be an opportunity for the investor. Now, as of now, all prominent equal weight indices have higher valuation than their parents. But this picture keeps changing. For instance, about 3 years ago, as of December 31st, 2021, the Nifty 100 equal weight index was at a considerably lower valuation multiples as compared to its parent. So it's a worthwhile to keep a watch. Now, a related feature of an equal weight index is that it automatically reduces allocation to overheated stocks and increases it to those that aren't. In a market cap weighted index, stocks that go up tend to see their weights in the index go up too. But an equal weight index adjusts the weight periodically based on the rebalancing frequency. Of course, this is opposite of what momentum investing does. So if a stock continues to go up, an investor in an equal weight index stands to lose. But if the idea is to reduce risk and invest in stocks that have yet to take part in a bull run, the equal weight index does it well. The next aspect of an equal weight index is that it better reflects the composition of its underlying index. Since large cap stocks have a high free float, even in the more diversified indices, they command a lion's share. For instance, consider Nifty 500. While it has 500 stocks from the large, mid and small cap space, over 70% of the index weight is still assigned to large cap stocks. That's when as many as 400 stocks are not large caps. Now, equal weight indices solve this problem by making multi-cap indices more multi-cap-like. In the Nifty 500 equal weight index, only 20% allocation is to large caps. Mid caps have a weight of 30% and small caps constitute the remaining 50%. So while the Nifty 500 is large cap heavy, the Nifty 500 equal weight is mid small cap heavy, which better reflects the composition of the index. Lastly, the equal weight factors can be a good tool for diversification in terms of performance vis-a-vis other factors. Take a look at the calendar year performance of various factors based on the closest passive indices. Over the past 6 calendar years, the Nifty 100 equal weight index was among the top 3 performing factors in 2021, 2022 and 2024. This makes it a decent option to diversify a factor fund portfolio. To summarize, equal weight indices have some distinguishing features, including they contain concentration both at the sector and stock levels. Their performance depends on broad-based performance and not on selected stocks and sectors. Their valuations can differ from those of their parent indices. Equal weight multi-cap indices better reflect the composition of their parent indices. They can help diversify a factor-based portfolio. Now do note that these are the features of equal weight indices and not advantages or disadvantages. Whether these features turn into advantage or a disadvantage depends on market conditions. Okay, let's now move on to the second part of this video, performance of equal weight indices versus their parents. But before that, if you're finding this video useful and are interested in more such videos, do subscribe to the channel and don't forget to press the bell icon so you never miss a video from us. Let's now check the performance of various equal weight indices vis-a-vis their parents. Now, there are 4 equal weight indices for which funds are available: Nifty 50 equal weight, Nifty 100 equal weight, Nifty 500 equal weight and Nifty top 10 equal weight. So let's check the returns of these indices versus their parents. For the Nifty top 10 equal weight index, the parent is the Nifty 50, as this index invests in the top 10 companies of Nifty 50 in an equal proportion. The return metric that we will use is called average rolling returns. Now, average rolling returns are derived by averaging all instances of a periodic return between 2 dates. For instance, average 5-year rolling returns are calculated by averaging all 5-year return numbers between 2 dates. Now, given the large number of samples, the average rolling returns is a more robust and reliable metric than trailing returns. So let's consider the average 1, 3 and 5-year rolling returns of these indices. As you can see, except for one case, across all periods, the equal weight variance performed better than the parent. The difference can be quite steep too. For instance, over 3-year periods, the Nifty 50 has delivered an average rolling return of 12.2% per annum. For the Nifty 50 equal weight, that's 17.53%, a wide gap of 5 percentage points. Even the Nifty top 10 equal weight, which consists of 10 biggest companies by free float market cap from the Nifty 50, has done better than the more diversified Nifty 50. This is probably due to the concentrated portfolio in terms of the number of stocks. For more information on this aspect, you can watch a recent video on comparison of focused and diversified funds. The link is in the description. Now this gap is narrowest in the case of the Nifty 500's average 3 and 5-year rolling returns. The Nifty 500 equal weight index is ahead of the Nifty 500 by just 0.83 percentage points in terms of the average 3-year rolling returns. In terms of the average 5-year rolling returns, the Nifty 500 has done better than its equal weight counterpart. Okay, let's now check the volatility of these returns. For that, we will use a metric called the standard deviation. The greater the standard deviation, the more the volatility. Now the Nifty 50 equal weight index is more volatile than the Nifty 50 across all time periods. On the other hand, the Nifty top 10 equal weight does a decent job. It's comparatively less volatile than the Nifty 50 across 1 and 5-year periods and almost as volatile across the 3-year period. The Nifty 100 equal weight is more volatile than the Nifty 100 across all time frames. So is the Nifty 500 equal weight. Overall, almost all equal weight indices are more volatile except the Nifty top 10 equal weight index. Now that's understandable as this index has the largest names, which tend to be comparatively less volatile, and other equal weight indices have higher allocation to smaller names as compared to their parent indices, which lends them higher volatility. So you can expect equal weight indices to be more rewarding but also more volatile. Now a look at the risk adjusted performance can help us assess the returns in light of the risk of both equal weight and market cap based indices. To get risk adjusted returns, let's divide the rolling returns by the standard deviation of those rolling returns. Nifty 50 equal weight and Nifty top 10 equal weight are the only two indices that do well on this metric, with the Nifty top 10 equal weight emerging as a clear winner. Now what that means is that while the other equal weight indices may deliver higher returns, they also take correspondingly higher risk for those returns. Alright, let me summarize the key findings of this video in the concluding section. Equal weight is a strong factor that can dramatically alter the characteristics of its parent index. It offers a lot of features we discussed earlier in the video. Now by allocating equal weights across all the companies with an index, it shifts the focus away from the larger names and to smaller names. This can significantly boost returns, but the volatility goes up even more sharply. But two equal weight indices are rather better than their parents, the Nifty 50 equal weight and the Nifty top 10 equal weight. These two factors can increase the returns while containing the volatility. Now, given this behavior of equal weight indices, you can assess if they can be a good fit for your portfolio based on your risk appetite and requirements. And this is what I had for you today. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.